Good morning, traders. It's Tuesday, November 25th. Hopefully everyone had a great evening and morning. Taking a look at the equities today, we have a little bit of a mixed market. NASDAQ down 0.2%, the S&P 500 flat, the Dow slightly positive, and the Russell up 0.4%. So what this is telling us, yesterday in pre-market, we saw the NASDAQ up the most and the Russell was down. And then by the end of the day, everybody piled into all sectors and all asset classes pretty much. It started to feel like a FOMO day, although we didn't have FOMO on our indicator. Definitely felt like people just wanted into everything and they were pointing to much higher pricing, and this was a buy the dip mentality. Today we have the large caps down, as I mentioned, the NASDAQ, yet the Russell is up. So this is going to be very interesting because it feels like now the FOMO is carrying over into today. And the average trader is chasing big returns. They think the market's going higher, which is why the Russell is up the most. So it'll be interesting to see if this market does reverse and catch most of these people off guard. This is similar type of scenario in terms of kind of the sentiment. We're going to see the market gap higher. The Russell will be somewhere a little bit higher. Well, let me just flip over to the Russell here. If we take a look at the Russell, so we had the FOMO kind of move there, and today we're going to see it open a little bit higher. And if we look and zoom in on the Russell here, you can see we got some red shaded areas telling us a couple of things. Well, first off, it was in an uptrend, then it went neutral to orange bars. Now it's in a downtrend, and as we know, bounces and gaps to the upside generally get sold into. The trend is down, and I think it's a little bit of a FOMO trade. People chasing returns, trying to get positioned for big money to be made, expecting this daily chart here to rip to the upside. Now, it may do that still, but overall, the trend is down, and we don't look to buy, or I don't look to buy bottoms or pick bottoms. I let it reverse. I will pay a higher price knowing it has got a good chance of it going higher than just buying it on a bounce that could easily get sold into, and we could be making multi-month lows here in 2 or 3 days. So again, it's not about trying to catch tops and bottoms. It's about trying to identify what the odds are, the statistics of what are the odds of getting into a position and it working out. And right now, the markets are having bounces within a downtrend. We don't want to call them bottoms. We don't want to think they're a bottom until proven that they are a bottom and that there's significant money flow moving in. Now, today we are seeing bonds. If we take a look at TLT, we got bonds having a nice big move to the upside, some pretty heavy volume in that space. And of course, it's pushing higher. The short-term analysis, obviously, it came down, went neutral. It's in a kind of a red trend, a little overbought. So again, really mixed signals on the bond market. When we zoom out on bonds, it is channeling and trending higher. The short-term momentum is actually showing it that it's kind of in a downtrend, although we could argue it's putting in a rounding bottom, but that's zooming in a little bit too close. In the big picture here, we just want to look at overall as channeling up. The moving averages are layered fairly nicely here, and it's starting to head higher. And if there's fear in the market, then we tend to see bonds want to move up a little bit, and that is a good thing. We want to see like NASDAQ down and bonds up. We want to see that relationship come back into play. There's a lot going on with the potential with, one group of people want rates to go down. The other group, I think are naturally the technicals are pointing to higher rates. We've got inflation problems. I think there's a lot of wild cards around interest rates and how bonds will react. And if we take a look at the crude oil chart, crude oil is definitely been in a downtrend, telling us it's expecting the economy demand to slow, and that is where we're at. Now we're at the significant pivot point here. We're getting down to this significant pivot point that if this level is broken, we are dropping very quickly down to the low 50s, most likely into the mid 40s. And of course, they'll probably be on the back of some news that's going to trigger it. But the charts are already telling us that. More or less, if we look here, it would be something like this. This was another one of these levels. This here was another one of these levels. And now we're at another one. And you can see what happens when you break these significant levels. It just is another leg down. The charts are already telling us it's going down into the 40s. So when news comes out, people will say, no, the news caused it or triggered it. Well, the way I look at it is the charts are already telling us that we're heading down into the 40s. And the news is just going to be that little thing that helps give it a little bit of nudge and potentially push it over that line. But again, it's already been doing this over and over again. It is a downtrend. And as we know, trends are more likely to continue than they are to reverse. So the charts are already saying we're going down there. But The reason I bring it up is so many people just track the news and they think they should trade around the news, but the news is random. Nobody knows when the news is coming out. And the second it comes out, it's already too late. It's already news, and the robots have already created these giant sharp moves. So you really just have to play the trends, and the news will eventually unfold in your favor, you'll notice. That's probably one of the biggest takeaways I learned over the years is forget the news, just follow the charts, and then the news just works in your favor and helps sometimes push it over the lines or get you to those levels, those targets we're looking for. My point going to oil was actually about if oil breaks down, oil is a big chunk of the inflation rate. And of course, if oil breaks down, then we're going to see inflation drop dramatically, which means there's room for the Fed to cut rates if the environment gets fairly ugly. And if they drop rates, then bonds could go higher. So there's all kinds of interesting things at play here. And as we know, the markets are interwoven. I call it intermarket analysis. They're all linked in one way. When something breaks down or rallies to the upside, it is making other things in other pockets of the financial space move as well. So that's important to understand. And just a reminder, it's been on my mind here, 43.8% of you that watch my analysis here haven't yet subscribed to my channel. So if I could ask you a favor to help out, if you like the content I share and you want to support the channel for free, a simple way to do this is to just hit the subscribe button and follow what we do and what I share here. My commitment to you is to try to put out more content that's educational, that's actionable. I do read your feedback and I share topics, and I'll cover more topics from what you guys want me to share and teach in these videos. So please subscribe if you like what I do here and share it. And thanks so much. Now, if we take a look at the dollar index down a little bit this morning, it's carving out a rounding bottom. I'm still bullish on it, but maybe it's going to take a little bit more of a pause. We do have gold and silver having a nice pop here. Gold up 1.25%. Silver is up 2% this morning, which is no surprise. We're expecting, no matter what happens with the stock market, more or less, we're expecting based on the longer term chart patterns and historical price patterns in this similar scenario is we see precious metals move higher. So they are starting to find a little bit of a bid. If we take a look at gold miners real quick, like GDX, they're actually going to open lower this morning, which is surprising. Let me just check the juniors and see if they're the same. Yeah, so miners are set to open a little bit lower this morning. Now, they did have a rip your face off type of day yesterday. They were all up 5 or 6%. The GDX, GDXJ, SILJ, if we go down here as well. They all posted huge gains. And when something has that big of a move, there's usually a little bit of a pause or pullback, a little bit of profit taking in post-market and early morning trading, and it sells down a little bit. So that's just normal, but overall, probably they will find a bid again today and want to push higher. So if we take a look at Bitcoin, it is trading lower today, and so is the NASDAQ. They're kind of both struggling. Again, steer clear of Bitcoin. It doesn't look like a very good trade. I would not try to pick a bottom here, a bounce. It may bounce, but it could. It's in a downtrend. As we know, trends are more likely to continue, and if you were to just follow this trend right here, that's kind of pointing to, like, I'm not saying it's going to go down to 50 or 60,000 at this point, but it could very easily just continue to have some more red bars, and it might want to break this low here. The market is always gunning to break significant pivot lows and pivot highs, and then before it reverses, like over here, you hit a minor high, and then boom, it gets hit. You hit a new minor high. Over here, you hit a minor high, it reverses. You hit another minor high, it reverses. It does the same to the downside. It may have another red bar here, red leg down, and flush that before putting in a bounce, which would just bring it back to where you potentially are buying it for a bounce. And I find this happens all the time. I learned this a long time ago, that when something looks primed and ready for a bounce, this is what I have seen happen, and I've to myself over and over again. I'm like, ooh, this looks like a bottoming candle. You buy it here expecting it to bounce up, and what happens is that fear continues and it breaks and it runs some other low and it sells off in a big way, and then finally, boom, you're only off 2 or 3 bars, but then it has a big bounce. And it bounces right to where you break even, and then it goes down and it breaks down and it continues pressure until eventually you're like, I just got to get out of this. You take a loss, and then boom, it rallies afterwards. So picking a bottom is dangerous just because in a lot of cases, some of the biggest percentage moves happen in the last couple of bars, right? When you think it's bottoming, the bottom drops out. and then the bounces just come back to where you thought the bottom was. And that's the way the markets are kind of designed. It works emotionally that way. It knows where those levels are. So just be cautious from that regard. So last but not least, a few of you have been talking about you want to see what happened in 2000 during the tech bubble burst when the market sold off for several years, a 3-year bear market, and what happened to gold. So let's just take a look. Obviously, it was a very different type of price action, but there are some similarities. Now, there was a huge rally in gold at this point, but gold obviously was trending down the yellow line while the stock market was going higher. So it was definitely a different vibe, different environment at that time. And then what also happened, and this is the part that I think is inevitable at some point when the stock market does sell off. Eventually, the market did start to sell off. Whoops, grab the pencil. As it started to sell off and went into its full-on bear market and really sold off. This was a fairly dramatic sell-off here, a 30% sell-off over a few months. This sold off, and also what happened was gold did the same thing. Gold eventually sold off and crashed as well with it fairly significantly. And so this is the phase, this is the window that I think investors need to understand is there is a point in the stock market when it rolls over and kicks into a bear market and everybody starts to panic that it naturally pulls gold down with it temporarily. And then gold eventually all of that kind of cleanses itself, and then it seems like the precious metal space finds the bottom well before the stock market does. The stock market continued to sell from this point on. It continued to sell off another 28% from there. So it's this first window, this first big section that naturally is going to pull gold down with it. Now, beforehand, gold did a very different scenario. But if we go over to if we go to 2007, the scenario we have going on here is rising gold, rising stocks. And as the stock market starts to sell off for this first wave, this is when we see that final push higher in gold. This is the scenario I do feel like we're unfolding, but this is the part that investors need to understand is there is this window, the first big chunk where the stock market really breaks down into a bear market and financial reset and has that initial huge collapse. That look at the yellow line here. If you look at gold, it's sold off, 34%. So that is the window we need to be aware of in the markets when we get there. The big question is gold going to push higher for this last big move? If so, that'll be great. But just realize there is a window of liquidation where investors panic and they just sell everything. They don't know what to do. Everything feels like it's falling in value. And that's when they can dump everything. And it is the case in this scenario. Stocks are on average going down. Gold has already topped and is going down. They don't have any safety. Everything is going down. And so it just creates this big landslide of everybody dumps everything until the group of people who are going to bail out and dump their positions are done. And then suddenly you'll notice gold put in a bottom months and months before the stock market, and gold ripped higher and took off for many years. The stock market bottomed later. That's the same over here in 2000. We saw everything sell off together. And then suddenly, once all that wave was done, gold stabilized and gold took off really, a couple of years before the stock market actually continued. It's just this window of selling you need to be aware of that can hit precious metals. And let's take a look over at silver real quick. Silver in this window ended up falling roughly 14%, although it from the peak that it did make, it was a much higher pullback. If we take a look here, down about 27%. So anyway, this is it's a bit different leading into the bear market in 2000, but when we enter the bear market phase where everybody starts to liquidate, excuse me, that is when we tend to see everything move down for some percentage. Now, these percentages for gold and silver were much smaller than what we saw in 2007, 2008. Silver fell 60+%. So we just need to be aware there is potential between 27 to 60+% correction, which is a pretty big haircut, especially if you're heavy weighted in precious metals. That it can do a huge dent and damage to earnings and growth of your account. Anyways, that's it for this morning. Let's just go back and take a quick peek. What else is going on here? I think that's about it at this point, and we'll talk soon. Ciao.